In recent years, the U.S. housing market has experienced significant changes as hedge funds and institutional investors increase their footprint. Once driven largely by individual homeowners and small-scale investors, the residential real estate sector has seen growing involvement from hedge funds and private equity firms, fundamentally altering market dynamics. Hedge funds and private equity firms are fundamentally altering market dynamics in the residential real estate sector, which is more than just a trend. This shift is contributing to inflationary pressures and worsening the affordable housing crisis, with a long-term impact that cannot be ignored. This article examines the data-driven realities behind hedge funds' role in the housing market and its influence on inflation, providing a clear understanding of what is happening and why. Hedge funds and institutional investment in housing, data on institutional home purchases. According to a 2022 study by Redfin, institutional investors bought 18% of all U.S. homes in the third quarter of 2021, a record high that reflects the surge of interest from hedge funds, private equity, and other large investors. In specific metropolitan areas, this number is even higher. For example, in Atlanta, hedge funds and institutional investors purchased nearly 25% of available homes in 2021. Invitation Homes, a leading institutional buyer, owns over 80,000 single-family homes across the United States, and Blackstone, through various vehicles, has made massive investments in residential real estate since the financial crisis. By acquiring single-family homes and turning them into rental properties, hedge funds are not only limiting the supply of homes available for purchase, but also shifting the balance of the market away from homeownership and towards rentals. Concentration of ownership. The concentration of ownership is another key factor. In 2021, the top 5 institutional investors in single-family homes collectively owned nearly 400,000 properties. This level of control has wide-reaching implications, particularly in cities where these firms have a significant market share. In Phoenix, for example, institutional investors own over 30% of the rental homes, contributing to sharp rent increases and further pricing out potential homebuyers. This data points to a broader trend. Hedge funds are cornering the market in key cities, driving prices higher and reducing the opportunities for average Americans to buy homes. It is a fact. Impact on housing prices and affordability. Rising home prices. The increase in institutional investment has directly impacted home prices. According to the National Association of Realtors, the median home price in the United States increased by 15% in 2021, with institutional investors playing a significant role in this surge. In markets where hedge funds are active, such as Atlanta and Charlotte, home prices rose by as much as 25%. Institutional investors often outbid individual buyers by making all-cash offers, something that most families simply cannot compete with. This practice pushes prices higher, making it more difficult for first-time homebuyers to enter the market. It also artificially inflates home pricing and community value. Converting homes to rentals. Hedge funds convert many of the homes they purchase into rental properties, which have its own set of consequences. A 2022 study by the Joint Center for Housing Studies at Harvard University found that rents have increased by an average of 11% nationwide, with some areas seeing rent hikes of over 20%. The conversion of homes into rentals by institutional investors has limited the supply of homes for purchase, exacerbating both the affordability crisis and the inflationary pressures associated with shelter costs. The Federal Reserve's data shows that shelter costs account for 32% of the Consumer Price Index, making it the largest single factor in measuring inflation. As institutional investors continue to raise rents and limit the availability of homes for purchase, they are contributing directly to rising inflation more than other factors. The role of hedge funds in inflation. How housing affects the CPI. Housing, as measured through shelter costs, rents, and owner-equivalent rents, is a significant driver of inflation in the United States. Since 2020, shelter costs have risen faster than any other component of the CPI, and this trend has continued in 2023. The Federal Reserve noted that shelter costs increased by 7.9% year over year, as of mid-2023, the largest increase in decades. Hedge funds, by raising rents and limiting home purchases, are exacerbating these inflationary pressures. A Goldman Sachs report highlighted that rent increases are expected to contribute 50% of the overall inflation rise in the coming year, with housing inflation being a significant factor. Distortion of market forces. Hedge funds have an advantage over individual buyers because of their access to capital. They can gain properties at scale and either hold them for rental income or resell them at a profit as home prices appreciate. This practice distorts market forces as it often prices out individual buyers, increasing the control of hedge funds over both the purchase and rental markets. As prices rise, hedge funds can generate higher returns on their investments. But these returns come at the expense of affordable housing and exacerbate inflation. Supply chain constraints and geopolitical factors. Supply chain and construction costs. Another important factor driving housing inflation is the ongoing disruption in global supply chains, which has led to an increase in construction costs. The National Association of Home Builders, or NAHB, reported that the cost of building materials such as lumber, steel, and concrete increased by 40% between 2020 and 2022, contributing to the slowdown in new housing development. Hedge funds, with their substantial financial resources, are less affected by these cost increases, further enabling them to dominate the market. The global investment shift. International investors, especially from countries like China, have increasingly viewed U.S. real estate as a haven for their capital. In 2022, international buyers accounted for over $59 billion in U.S. home purchases, further limiting the supply of homes available to domestic buyers because of foreign property ownership. Hedge funds, recognizing the opportunity for capital appreciation, have aligned with these global trends, further driving up prices in key markets and contributing to the inflationary spiral. Policy solutions. What can be done? Regulating institutional home buyers. One potential solution to the housing affordability crisis is the regulation of institutional home buyers. Several local governments have considered policies that would limit the number of single-family homes that hedge funds and private equity firms can own in a market. These measures would help level the playing field for individual buyers and potentially slow the rise in home prices. Expanding affordable housing initiatives. Another potential policy solution involves expanding affordable housing programs. The federal government, through agencies like HUD, could incentivize the development of affordable housing through tax credits and subsidies. HUD and other federal agencies could provide incentives for hedge funds and institutional investors to invest in affordable housing, which would help balance the market. However, this could cause higher inflation and higher home prices, potentially pricing out more Americans. Same story, new crisis. The dominance of hedge funds in the housing market represents a fundamental shift in how real estate operates in the United States. With institutional investors controlling significant portions of the housing stock, home prices and rents are being driven up, exacerbating inflation and making it harder for average Americans to achieve homeownership. The long-term consequences of this trend are concerning, particularly as inflation continues to rise and wealth inequality worsens. Policymakers must act now to address these issues before they become even more entrenched. Hedge fund institutions have hedged the real estate economy against the economy, and the problem is only beginning. Please subscribe and hit that notification button to hear more from us.